Markets are starting to settle down a little bit as the calm after the storm sets in. A banking crisis has been averted as the Fed and Treasury and the FDIC jump in and backstop the deposits of the bank, not the banks themselves. So a lot of people are calling what happened over the weekend a bailout. It's actually the opposite of a bailout because in a bailout, typically the shareholders, the equity is retained in the company through taxpayer dollars. In this scenario, the equity gets wiped out and the taxpayer dollars are not at risk. This is Fed balance sheet money, which is just printed. So it's not coming out of the taxable revenues of the government. It's money that's created by Treasury. They literally, push a button and, the Fed and create the liquidity to guarantee the deposits of the people like you and me that have our deposits at banks. So that's what that's all about. That was the right thing to do to make sure that the public does not lose their money when we are basically forced to put our money into financial institutions and banks. We're supposed to be able to rely on them. We have FDIC insurance up to $250,000, but above that, I think it was the right thing to do for them to come in and make everybody whole in that situation while getting rid of the people that work at the bank, the leaders, the equity, the bondholders, and the investors because they were poorly operated. So I think that was a good thing to do. But the interesting thing is what the market's initial reaction was and what some of the initial commentary was that this was a Fed pivot, that the Fed is going to stop hiking. The Fed's going to even maybe back up and start QE again and get rid of QT, all those types of things. And you've heard me talk a lot on this channel about the Fed will continue to hike until something breaks. And when something breaks, that could be a banking failure. It could be the bond market. It could be credit markets. It could be the stock markets, having a complete meltdown. So that's what breaking looks like. And what we had this weekend and what we're seeing with these banks failing, obviously, these are smaller banks in the schemes of what are considered systemically important banks. And, banks that have certain special regulations and protections by the government because they're so big. And these were smaller banks that were living outside of those guidelines and those rules and those stress tests. So interesting environment. And the Fed is not done hiking or tightening by any means. And we'll talk about that in a minute. But when Federal Reserve starts to raise interest rates, it generally keeps going until something breaks, or so goes the collective wisdom of Wall Street. So with the second and third largest bank failures ever in the books happening just over the past few days and worries of more to come, that would seem to qualify as a significant breakage for the central bank to back off. Not so fast. Even with the failure over the past several days of Silicon Valley Bank, Signature Bank, forced regulators to spring into action, markets still expect the Fed to keep up with inflation-fighting efforts. Surging bond yields played into the demise, in particular, of the SVB, Silicon Valley Bank, as the bank faced some $16 billion in unrealized losses from held to maturity treasuries that hold lost principal value due to higher rates. But still, the dramatic events may not even technically qualify as something breaking in the collective Wall Street mind. Quincy Crosby said it does not qualify because it is not enough to qualify for the kind of break that would have the Fed pivot. And the market certainly doesn't think so. And the reason is, what would cause the Fed to pivot? So we'll talk about that in a minute. Goldman Sachs came out and said that it does not expect the Fed to hike rates at all this month, though there were few, if any, other Wall Street forecasters who shared the same view. Goldman was probably in a trade. That's why they're coming out saying that to pump the markets. And then other economists are coming out and saying, this isn't going to do anything and that the Fed officials are unlikely to pivot at next week's meeting by pausing rate hikes. In our view, doing so would invite markets and the public to assume that the Fed's inflation-fighting resolve is only in place up to a point where there is any bumpiness in financial markets in the real economy. Powell has said over and over, there's going to be pain to get inflation down. And the big thing is nothing has changed over the weekend. Prices haven't changed. The labor market hasn't changed. Inflation hasn't changed. We've got CPI coming out this week. So what this does show is that the Fed can keep tightening. They can keep hiking while they deal with other systemic risks in the economy, which they did say previously. Powell said, I would rather risk over tightening because we have the tools to deal with those things versus under tightening and inflation continues to run rampant. I put a tweet out saying that this is not a pivot. In fact, it's the opposite of a pivot, because you could argue what the Fed has done is somewhat inflationary. Why? Because of the market reactions. And we'll take a look at bond yields right now. The 10-year right now dropped because of the flight to safety, all the way down to about 3.5%. That reduced mortgage rates by about about 0.5%. So, that's an inflationary move. You have oil, dropping again. You had gold spiking. All of these things are inflationary move. Commodities are probably spiking as well. You have the dollar heading down a little bit. And of course, the VIX, like we've been watching, is popping. Popped today, retraced, and is working its way back up again. So with what the Fed did, it actually encouraged markets. We had a nice little bounce in the markets today on the Dow, the NASDAQ, the S&P. Now let's take a look at Bitcoin, popping again today, almost back up to 25,000 again, broke through this trend line range that we've been looking at. These are all inflationary things right here. So it's actually the opposite of a pivot is what's happening. It's actually spurring more inflation, which is going to give the Fed more cause and more ammunition to keep tightening. Now, what this probably did do, depending on the inflation print, was reduce the chances of the Fed going 50 basis points. I mean, it was about 75-80% that the Fed was going to hike by 50 basis points at this next meeting, because the labor reports have been so hot lately. All the inflation data has been coming out, and the inflation print tomorrow will probably be pretty hot as well. The Fed meets next week, so it'll be interesting. But right now, most likely outcome is 25 basis points. I'm not sure the Fed wants to risk 50 basis points because of the pressure and the stress that some of the banks are under that invested in long duration bonds, and are now forced to sell those to meet liquidity requirements. But with the Fed doing what they did, they kind of took that off the table. So they could, but chances are more likely of a 25 basis point versus a 50 basis point rate hike coming up at the next meeting. And again, nothing else has changed in terms of what the Fed has to do. Inflation is still high, prices are still high, everything is still the same. The only thing that changed was a few arguably larger banks than back in 2008 and 9 in terms of the size, couple $100 billion. But JP Morgan is trillions of dollars. Bank of America is, I don't know, 1 or 2 trillion. Wells Fargo is up there in the $1 trillion range. So, these banks are way larger today than they were back in 2008 and 9. 200 billion was big back in 2008 and 9, but when you adjust for inflation, move forward to where we're at now, look at how many banks are at the $100-200 billion mark. It's really not that huge of a situation or a deal, other than the fallout that could have potentially damaged the economy and things if the depositors were not made whole and ended up losing all their money. That could have reverberated through the economy and the venture capital world and banking at large. And then the question becomes, well, what do you do with your cash? Do you buy crypto? Do you buy Bitcoin? Do you put it in bonds? Do you break it up amongst other banks? The big thing is that you want to think about, if you have and this backstop that the Fed put in place for depositors is essentially an unlimited guarantee of deposits at banks kind of across the board right now, without them saying that exactly. It's kind of what they've done. But that still doesn't mean that it's always and forever going to be the case. And if we had a huge systemic global meltdown of banks, which obviously we're not facing that right now, this was an isolated case of a bank that was very poorly run, very poorly managed. And, some people are going to be held accountable for that, possibly, even criminal charges. We'll see, depending on what happens, based on, what comes out after the fact. But, a lot of bad things going on behind the scenes there at that bank before all this went down. But, the question is, what do you do with your money if you have more than $250,000? Break it up into multiple accounts in different banks, different entities, things like that. You can buy treasuries. That's part of the problem that's causing a liquidity crunch with the banks, is that a lot of people are moving their cash deposits into treasuries because of the yield that you can get on that. So that's putting pressure on banks. You can put it in money market funds. Of course, you can store it in real estate. That's traditionally been one of the best places to store wealth, is in real estate. Real estate prices have been overinflated. and hyperinflated over the last couple of years. So you got to be careful there. But those are the types of things that you want to do to kind of safeguard. You could buy Bitcoin. There are some systemic risks there with the exchanges and things like that. So you have to watch out for that. Make sure that you store the Bitcoin yourself in cold storage. And then the risk there, the counterparty risk there is that obviously your device can get hacked in your computer when you're, storing those things and bringing it out of storage. The exchanges can get hacked, the exchanges can go down. So there's still risk even with Bitcoin and cryptocurrency. So nothing is 100% safe, but it is good to know that for now, your deposits on banks are relatively safe and guaranteed by the government. And, that is one of the reasons why the United States has the world reserve currency, because we can do these things and, with little to no consequence to the overall economy and things like that. So keep an eye on markets. We'll see where they close by the end of the day and, how things continue to look throughout the week with CPI and things. But I do not expect the Fed to stop hiking. I think they're going to go ahead and go 25 basis points minimum. They're going to keep quantitative tightening and they're going to keep at inflation because nothing else has changed on that front. In fact, like I said, you can argue what they did do could be inflationary. So that means they're going to have to continue to go harder. So these are the things I'm looking at. I'll see you in the next video.